In prior videos, we looked at fringe benefits and cafeteria plans. Now that you know what fringe benefits are, let's look at the rules we use to value the fringe benefits. In this video, we'll talk briefly about general valuation rules for fringe benefits, but spend most of the time on learning about valuing transportation benefits. There's the General Valuation Rule, or GVR, which is the most common way to determine the value of fringe benefits. Basically, you're using the fair market value. For the personal use of company vehicles, though, three primary methods exist for determining the taxable income for the employee: the lease value rule, the commuting rule, and the 3 cents per mile rule. Let's start with the lease value rule. This rule is used when the employee uses the vehicle for work, commuting, and other personal use. IRS Publication 15B provides an annual lease amount for vehicles. So for instance, if the fair market value of the automobile on the first date it is available to the employee is $34,850, the annual lease value is $9,250. This annual amount is multiplied by the percentage of the employee's personal use of the automobile, meaning we take the days the car is available divided by 365 days times the personal percent of use to determine the amount of the employee's taxable income. If the employer also provides fuel, it must be included in taxable income at 5.5 cents per mile of personal use. To practice this lease value rule, let's look at the next example. Quinn is an employee of Caribbean Imports. His company car is a 2023 Toyota Prius LXE with a fair market value of $30,000 and a lease value of $8,250 according to Publication 15B. During the year, Quinn drove 36,953 miles, of which 6,822 were for personal use. The car was available for use on 250 of the days during the year. All gasoline was provided by the employer and is charged back to Quinn at 5.85 cents per mile. What is the amount of the company car fringe benefit that will appear on Quinn's W-2 using the lease value rule? We start with the annual lease value of $8,250 that is provided in this example. This amount is an annual amount, which means that the employee would be taxed on the entire amount if the employee used the car the entire year and only drove the car for personal reasons, such as commuting to work. In our example, though, the car was only available on 250 days of the year. And Quinn drove 36,953 miles, of which only 6,822 were for personal use. So our first step is to prorate the annual lease amount for 250 days. We do that by dividing the 250 days by 365 days, and it tells us that the car was only available for 68.493150% of the year. Then we find the personal use percentage by dividing the personal miles of 6,822 by the total miles of 36,953, and the result is 18.46128866%. We now multiply the lease value of $8,250 by 68.493150%, and then multiply it by the personal use percentage of 18.46128866% to arrive at $1,043.19. We also add the cost of the fuel that Quinn's employer paid for by multiplying the personal miles by 5.85 cents per mile. The value of the fuel is $399.09, and combined with the personal lease value of the car, Quinn will have an additional taxable income on his W-2 of $1,442.28. Let's look at the commuting rule next. You use this rule when the employee uses the car for work and commuting only. The commuting miles constitute personal use of the vehicle and is taxable at $1.50 per mile. So in this example, the employee drives daily commuting miles of 10 miles each way. The employee works 5 days a week for 48 weeks a year, which is 52 weeks less 4 weeks vacation, less 9 holidays. So we calculate the taxable income by calculating first the number of commuting days a year, which is 48 weeks times 5 days equals 240 days, minus 9 federal holidays is 231 days. 231 days times the round trip miles of 20 equals 4,620 miles times $1.50 per mile results in $6,930 of taxable income. Another method to value personal use of the company car is the cents per mile method. However, you can't use the cents per mile rule for an automobile, including a truck or van, if its value when you first make it available to any employee for personal use in calendar year 2024 was more than $62,000. In 2023, this limit was $60,800, and in 2022, it was $56,100. Under this method, you would calculate the miles for personal use and multiply it by the cents per mile rate. There are 2 additional requirements, the regular use in trade or business and the mileage test. And you can find more details in the IRS publication 15B. The standard mileage rate is 58.5 cents on January 1st, 2022, 62.5 cents as of July 1st, 2022, 65.5 cents in 2023, and 67 cents in 2024. Another method for valuing personal use of a company vehicle is the unsafe condition method. This rule applies if a company vehicle is provided to an employee only because of unsafe conditions. The foundation of this rule is that the employee would walk, bike, or use public transportation under normal conditions. In these cases, the IRS specifies that the taxable income is determined by adding $1.50 for a one-way commute. However, there are additional requirements such as that the employee must be an hourly worker and is not paid more than $150,000 in 2023 or $135,000 in 2022. In this case, you determine the taxable income by multiplying the one-way commute miles by $1.50. One additional transportation-related benefit to know about is that employers may exclude up to $280 in 2022, $300 in 2023, and $315 in 2024 from the employee's wages if the employer pays for the employee's transit pass.